Right, Morgan. You've got that look on your face again.
Yeah?
The one where you're staring at a chart like it holds the secrets of the universe. What's the S&P 500 telling me that my on-chain Bitcoin data isn't?
It's telling me about fear, Chris. Proper, grown-up fear.
Okay.
Not the, oh no, Elon's tweeted a dog picture jitters you crypto boys get. I'm talking about institutional, career-on-the-line anxiety. We're looking at the put-call ratio.
The what now? Put call. Sounds like something my nan does playing bingo. Break it down for the people in plain English.
It's actually dead simple. You take the total volume of put options being traded and divide it by the volume of call options.
Right.
A put is a bet the market goes down.
Got it.
A call is a bet it goes up. So the ratio is a live snapshot of market sentiment. Is the crowd betting on a crash or a rally?
So it's a mood ring for Wall Street. Ratio's high, everyone's bricking it, buying puts to protect themselves.
Exactly.
Ratio's low, they're all feeling like Gordon Gekko loading up on calls.
You've got the what, but the how is the clever bit.
Okay.
You don't use it to follow the herd. It's a contrarian tool. This is fundamental CMT level 2 stuff.
Okay, so when the mob runs left, you look right, I get that.
Precisely.
In crypto, when every influencer is screaming, we're all gonna make it, that's usually the top signal in it.
It's exactly that psychology. When the put-call ratio gets to an extreme, let's say over 1.2, it means absolute hysterical panic has set in.
Wow.
Everyone who could possibly be scared has already bought their puts.
Right.
The selling is exhausted. There's no one left to push the market lower. For a contrarian, that's a massive flail going up, signaling a potential market bottom.
Intrigued. So you're basically timing the point of maximum pain. The moment everyone gives up, that's the entry. I like it. So what about the other way?
The flip side is when the ratio gets stupidly low, say below 0.7 or even approaching 0.5.
Okay.
That's peak euphoria, total greed. No one's worried, no one's hedging. Everyone's buying lottery ticket calls thinking they're a genius. That, my friend, is when the market is most fragile. It's when you need to be watching out for a rug pull.
A rug pull. See, you are learning the lingo. But hold on. Why is this so special?
How so?
Isn't that what the VIX, the main fear index, is for?
Good question. The VIX measures implied volatility, which is a forecast.
Right, a forecast.
It's what the market thinks will happen. The put-call ratio tracks what traders are actually doing with their cash. It's not an opinion poll. It's a receipt.
Oh, I see.
It's real money, real skin in the game, which is why it's such a powerful, practical tool.
Action, not words, got it. But I know you TradFi guys. It's never just one simple number, is it? There's always a catch.
You know it. This is where it gets really useful.
Go on.
The CBOE gives us different flavors. The two you need to watch are the equity PCR and the index PCR.
Let me guess. One's for the little guys and one's for the big dogs.
Spot on. The equity PCR tracks options on single stocks, your Teslas, your Nvidias.
Yeah.
That's largely the retail army, the Wall Street bets crowd. They're naturally optimistic, so that ratio tends to be low. You could call it the DGen index.
My people. I need that on a chart. So what's the other one?
The index PCR is for the S&P 500.
Okay.
That's where the huge institutions, the pension funds, go to hedge their multi-billion-dollar portfolios. That's the smart money indicator. And the magic happens when you see them diverge.
How so?
Picture this. The market's been rallying hard. You see the DGen index hit an all-time low. Retail throwing a party, buying calls with abandon.
Okay, yeah.
But at the same time, you see the smart money index quietly starting to tick up. What does that tell you? It tells you the pros are buying insurance while the public is taking shots. It's a massive warning sign.
That is actually a brilliant bit of intel. You're basically spying on the two sides of the market. So give us the scoop. What's the ratio saying right now?
All right, live alpha. As of today, the equity put-call ratio is sitting around 0.56.
Okay.
That is very low. It shows a huge amount of bullishness, a lot of complacency.
Wow.
As a contrarian, seeing that makes the hairs on the neck stand up a bit. It doesn't mean sell everything tomorrow, but it means the risk is elevated.
It's the same in my world. We have put-call ratios for Bitcoin on exchanges like Deribit.
Right.
Go back and look at the November 2022 bottom around 16K. The ratio was through the roof.
Yeah.
Everyone was betting on a fall to 10K. That was the maximum pain signal right before the reversal.
And at the 69K top?
On the floor, everyone was buying calls for 100K.
Wow.
The euphoria was off the charts. It's identical psychology, just with a different asset.
Exactly. Fear and greed are universal. The key is knowing how to measure them. But you're right to be cautious. You can't just blindly fade the crowd. Sometimes a low ratio just means you're in a strong, healthy uptrend.
So it's not a standalone trading system.
Never. It's an overlay, a confirmation tool.
Okay.
You do your normal analysis, find your key levels, your trend lines. Then, when price hits a major support level, and at the same time the put-call ratio is at a screamingly high level of fear, that's your A-grade setup. It's about combining technicals with sentiment.
Right, so to sum it up for the Big Short Club listeners, find the put-call ratio for your market. Don't follow the number, wait for it to hit a historical extreme that signals peak fear or peak greed.
Yep.
Then use that as your cue to look for a high probability trade in the opposite direction of the crowd.
That's the essence of it. It's about trading against raw emotion.
Right.
While everyone else is panicking or partying, you're the one staying sober and looking for the real opportunity.
Impressed. Solid gold, mate. Absolutely solid.
Now, here's a question we'd like you to think about.
If you know that extreme fear often marks a market bottom and extreme greed often marks a top, which emotion do you find harder to trade against? Your own fear when you need to buy, or your own greed when you need to sell? Have a think on that. We'll catch you on the next one.